Yeah.
Hi guys, this is Shyam from StockWiz, and I have Kishan with me. Hi Kishan.
Hi. Hi, Sham.
I know Kishan going back a few months now, and he's a CFA charter holder and a SEBI registered investment advisor. He is the principal of Flameback Capital, where he has a fairly robust investment array of investment advisories and portfolio management options. Kishan, can you give our viewers an overview of what it is that you do and where your interests lie and how you got involved, into this whole investment management scene?
Sure. Yeah. So Sham, hey, first of all, extremely excited that we're doing this. We both have the same passion and the same interests, and I'm extremely keen to see where this takes us. So about myself, we both live in the same city. I grew up here. All my life, uh, and I started off investing. I mean, almost as a kid. I for some reason got hooked on to watching the markets on CNBC, and there was something very exciting and interesting about it. The fact that you can make money by just sitting in your house and watching
Right.
things go up and down. Uh, I'm a lazy guy, so that always interested me that I could do something like that, um, and then you start reading and you start uh, thinking about the markets. I mean, like all the time, and 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 you start off, sometimes you have beginner's luck, and sometimes you get hit by a truck. So I think I did my first proper trade. I mean, I bought a few stocks before that, but that was in my mom's account and stuff. So that didn't count. But I started off investing, like I got up, I mean, my own portfolio and stuff like that. 1 week before Lehman Brothers went bankrupt, so I started. so I started. so I started off right in the middle of the storm, and it was I mean, I guess it would have been like 18 or 19, and that um, would have changed my perspective and changed I mean, changed everything, because I mean, when you're in that situation where where you do research and stuff, and then you see your investments fall by 40-50%, and and then you read most people lose 90% of portfolio, or 90% of people lose the entire money that invest or start trading with in the first year, and you think of yourself as one of them. I mean, you always think of yourself as an outlier. So you start off. So I started off, uh, initially trading off the tape, trying to, you know, and then this happens. So you change strategy, and then um, you know you read about value investing and stuff, and then you read about Warren Buffett and things like that, and that changes how you think and how you perceive things and stuff. And then what happened is, out of out of college, I joined this family office, this private investment firm,
Okay.
and they started developing algorithms. Um, and the thing is, I went from being a purely discretionary, fundamental based investor to believing in like algorithms, or or systematic investing, purely because it has a shorter feedback loop. When you invest based on a known investment strategy, or based on a known investment outlook, uh, where the risk and the risk and return parameters are predefined. Um, um, it helps you like understand what you can expect from a strategy, and if it stops working, it allows you to take a look from a on a non um, you know um, in a non-biased way, because you have those parameters predefined, and that pre-definition of those parameters helps you analyze the strategy and to see whether it's working or not. If you have a discretionary fundamental based approach, what sometimes tends to happen is um, um, you can hold a stock for many years. You could do everything right, but it might not go in your direction, and it's very hard for you to know whether you made a right or the wrong call. I mean, you might just get timing wrong, but the but the decision to invest might be not wrong, but the stock might not move for many years, and that feedback loop might take you 10 years for you to find out whether you made a mistake or not. And that for me, I'm the kind of person who likes instant gratification. So feedback. So for me, this was the biggest thing, and I like the process of spending a lot of time and energy and intellect in finding a strategy. Spending a lot of time in the back end, and then just deploying it, in a disciplined manner, and and having a strategy, like an algorithm, uh, helps you save the decision making, which is whether you should invest or not, because I think most people uh, are extremely exposed to our own emotional biases, and it works. You can do all the work, all the research. You could try to be, the greatest investor on paper, but when it comes to actually playing it, it's a different game altogether. And I think most people suffer from that, and I know I tend to get swayed by what's happening around me, what people are thinking, and then investment strategy helps you cut all of that out. It helps you just follow a path and a plan, and stick to it, because if you did the hard work, and if you did the right amount of research, and if you really thought through the strategy and tested it out in the right way, it might work, it might not work, but it won't. It's not because you made a mistake in its execution, and that is for me the other reason why I'm so interested in the path that I've chosen right now.
Right.
Yeah,
I mean, when I look back on why on how I got into the markets, it was
yeah,
purely by accident. In fact, for the longest time, I did not know any, jack shit about stocks or bonds or whatever.
yeah,
And in fact, my background was in computer science, and I actually want to get a PhD in programming languages, and that was kind of why I went to the US. But after spending like a year in upstate New York, I was completely miserable over there, and I
yeah,
decided to drop out with a master's. And I was looking, trying to figure out what to do next, and I got hired by Merrill Lynch. And thankfully, my first job there did not involve anything to do with actually managing money. It was about applying my computer science skills to analyze huge pools of mortgages.
yeah,
So they used to I'm not I mean, they still are, but they used to be big in the mortgage market, and at that point, the non-agency mortgages, which is basically mortgages that were originated by people like Merrill Lynch and other private players, was becoming a huge market. And investors in that space were for the first time exposed to huge credit risks, as well as interest rate risks. So they needed a way to model the whole thing out, figure out how cash flows work and so on in those in different scenarios. So when you package these, thousands of mortgages into like one structure, and you carve out different cash flows from them, you want to like analyze how those cash flows behave under different economic scenarios.
Yeah.
What if payments spike? What if interest rates fall? What if defaults rise, and so on. That's what actually got me into the market, because I think somewhere along the line I realized that investing is not some random stuff that you do watching
Yeah.
TV. Um, it is something that can be tackled in a very systematic way, and it can be tackled in a way that actually made sense to me, because I never understood how I mean even today when I see people analyze a stock, right? For example, they will say buy Page Industries because the market for underwear in India is huge, and everybody needs to wear underwear. So the market potential is awesome, and it is trading at X valuation, and I expect this EPS to grow Y. So even today, I kind of find it hard to believe that that is the right approach to take when it comes to investing,
Yeah.
because like what happens is when you look at the market, right? And if you look at the stocks listed in the NSE, there are 3,000 stocks approximately, right? Out of which about 1,000 trade at a fairly liquid, you know, with a fair amount of liquidity. So it is not humanly possible for an individual investor or any analyst, for example, to sit there and analyze each one and build a story around it. And most of and and from the way I look at it, um, whenever the market is going in your favor, right? So the so-called beta of the market, so all small caps are rising or all mid caps are rising, so you own a particular individual stock, and 90% of its returns, um, or maybe 99% of the returns you see in that particular stock could be just because of the market beta, right? So you don't have to be right, you just have to be not wrong. And in most cases, what happens is like a small subsection of the stocks catch the fancy of most investors, and it just goes parabolic. And if you are lucky enough to kind of get in, you might start thinking that you're some sort of an investment genius. um, but what happens eventually is that the luck that got you into that stock will also start reversing, and luck, as I say, is mean reverting in finance. And eventually if you don't have a process in place that continuously is looking to deploy capital in stocks in a systematic manner, then this sort of luck tends to go in the opposite direction, fairly quickly, right? Like you mentioned, you entered the market, before Lehman Brothers. So no amount of stock picking, right, would have saved you in that
Yeah.
situation, because when these sort of macro events happen, correlations go to one and everything tanks. And what happens is every maybe 7 to 8 years, this sort of events keep happening. So most of the time, instead of looking for those one or two so-called life-changing stocks, you're better off, investing in a strategy that, first of all, helps you navigate these sort of risks, right? So one thing I've written in, in the newsletter is that most investors look at returns,
Right.
and they say, give me the fund with the best returns, or give
Yeah.
me a stock that will double tomorrow.
Yeah.
But what they don't realize is that there's no such thing as risk-free returns in the market, right?
Right.
Everything involves risk. And when you focus only on returns, you're just looking at 40% of what matters in an investment,
Right.
and the risks are multiple. So the kind of black swan risk that you mentioned, with Lehman Brothers and this coronavirus panic that we've had recently, And in 2016 we had the taper tantrum, and before that was the momentum meltdown, or the quant panic or something like that, in the US. So what happens is, these things occur at a fairly reasonable frequency, but we don't know when it is going to happen. We can't time it. Uh, so whatever strategy you employ should have something over there that mitigates this risk, right? Systematic strategies is a way of, is a way of managing that risk rather than actually shooting for, trying to get on some sort of a rocket ship.
Right.
So if you believe that the markets, equity markets in particular, go up over a period of time, right? So they keep saying time in the market is more important than timing the market. But what they miss out is that when these sort of events occur, the chances of an individual investor completely exiting the markets out of panic is it's pretty high. So that whole time in the market goes for a toss, during these type of events. And part of the reason, in fact, all of my money is in systematic strategies. Not a single one is, kind of like a discretionary thing. It helps me define the risk and upfront, and I kind of know how it behaves under different circumstances, right? You mentioned reading, value investing books. Well, so that is one way to kind of look at the markets. There's obviously momentum, and then there's quality and all these factors out there, that has shown that, it can lead to better returns. But in order for you as an investor to be able to tap into those different streams of returns, you need a disciplined approach, that tells you what to do and when to do it. And from for a guy like me, I prefer order. Yeah, I prefer to see order in things, and markets are extremely chaotic. There's no order in the markets. So my entire sort of like approach to investing is trying to build a framework around that chaos that allows me to look at slices of that universe, in an orderly manner. So that's how I would kind of describe my outlook towards investing. So the reason why we started this newsletter is that, most of these concepts that we're going to discuss have been attacked from a very theoretical and, massively quantitative angle. So what we want to do was simplify some of those things out. When people say diversification, what exactly are they supposed to do? And when people talk about tactical strategies, what exactly does it entail? And and when we say risk management, what exactly is that, right? What exactly are you trying to manage? And also how this uh, kind of help you build a portfolio, and how do you think through the costs involved in it, right? Because what we do with, say, for example, direct equity investing, as I call it, right, involves costs that, that most people don't think through, especially first time investors in the market. In India, we have this securities transaction tax. It's like the worst tax in the world, right? Because they're taxing transactions, which is, in my mind, it's idiotic.
Yeah.
You can tax profits, you can tax income, but taxing transactions is, especially in the financial markets, lead to all sort of inefficiencies. That tax single-handedly killed market making. And people crib about how ETFs, are illiquid and there's no market making in India. Well, I would say the whole market making business has been killed because of STT. And until that goes, you can say bye bye to ETFs, because nobody is going to make markets anywhere. So anyway, so the my point, to step back, is that even though your brokerage may be free, thanks to discount brokers and whatnot, there is the biggest broker in India is the government, who is charging 0.1% of all equities being traded, as securities transaction tax. And whatever strategy you back test or you analyze, you have to include that tax in your calculation. I'd given an example of a sort of rapid fire trading strategy in the post. Almost 10% of your gross returns goes away in taxes. So in that particular strategy, so the more you trade, the more this STT has an impact on your overall returns. And without looking at it, you cannot really compare different strategies, right? So I can have a strategy that trades like for example, the one that I highlighted in the post. It trades every day. It's like a momo thing, and the returns are spectacular. Now if you take that and you contrast that with some sort of value strategy that trades once a year, for example, right? If you don't adjust for transaction costs and taxes, you're doing yourself a disfavor, right? You're going to pick the one with the higher gross returns, and that is not nowhere close to the returns you're actually going to realize in your portfolio. So for me, it's not just systematic investment; it's systematic risk management, systematic modeling of costs, systematic modeling of tail risk events. How is your portfolio going to behave under different sort of macro overhangs. And there are systematic ways in which you can actually time different factors, whether it is value or momentum or or quality. And I'm interested in in sort of kind of approaching the market through a map, right? And that map is may or may not be the terrain, right? It's kind of like a abstraction of the world, and it necessarily has to be. I don't know how many of our viewers have seen this series called Devs. Have you seen it, Kishan? Uh, Devs?
Doves?
Yeah, so
No,
DEVS. Okay, so it's like a
no.
bunch of. Okay, so it's like yeah, it's modeled after Google
Okay,
inventing some sort of a quantum computer, right?
okay.
And
What's the series
the
called?
devs, DEVS.
Okay, 1 second. I'm.
Yeah,
Yeah, I can't wait to look it up. Okay.
yeah. So they invent this quantum computer where that fellow recreates the world.
Yeah,
He recreates an exact replica of the world he lives in inside that computer, right?
yeah,
So unless you do something like that, it's impossible for any model to claim that it is accurate, right? It's
yeah,
100% accurate. So everything is an abstraction. You kind of reduce the complexity of the real world by building models,
yeah,
so that it helps you understand how your actions are likely to behave in the real world. But it's
yeah,
definitely not a predictive, definitely not a prediction game. It's
yeah,
a series of analysis that you do. But
yeah,
but that series is worth watching. It's kind of interesting in that if at all this whole quantum computing becomes a reality as depicted, in that
yeah,
it would be interesting to see how financial markets would behave on that news, because everything becomes instantly computable. So it's
yeah.
fairly interesting. So yeah, I think we have something lined up for the next post as well. Do you want to give a background of that, Kishan?
Yeah. So so one of the things that comes up in like in like investing is to is to have different approaches, right? One is you can have a core portfolio, which is a portfolio where you have your um, where you focus on your long term objective, and you buy stocks or or you buy investment products based on based on those goals, and those goals or that investment strategy does not change for a long period of time. And then you can have a satellite approach, where you try to take advantage of, say, short-term opportunities, try to like augment your return. You can even try to hit the jackpot, with a smaller portion of your money, where where you can take more risk, where you can afford to take more risk, versus an entirely tactical approach, where you come in and out of the market based on certain opportunities. So you deploy your funds, when you see an opportunity. You take risk, and then you cut back entirely. um, and then you cut back entirely when you think that, when you think your money is, when you don't see good opportunities. um, I mean, there's a lot of downside to that. So I think we will explore those next week.
Cool. So, all right. I think we kind of blown through a 15-minute,
Window.
time budget. Yeah, we set out, in the beginning. So we'll keep these videos short, as sort of like an
Yeah.
intro to what we've discussed, in the future. But yeah, all right, guys. Thank you for listening in.
Yeah.
And as you can see, this is a fairly non-professional video and blog. So if you want to leave any suggestions and on how to make this better, we recorded all of this on Skype, um, and maintaining social distancing and so on. So if you have any suggestions or thoughts on how to make this better, please leave it in the comment section of the post. All right.
Thank
Thank you very much. Thanks, Kishan. We'll do
thank
this
you.
again next week.
Yeah, for sure. Bye.